morning. It's happy to have you back in our new studio here at East Capital Group for our first update of 2024. And we have the Fed and Sweden's Riksbank this week that left rates unchanged, and central banks are signaling rate cuts. What does this mean for investors?
Well, I do think all the central banks are now very clear that rate cuts are coming. Powell said that it's not in the base plan to cut rates in March, but obviously that means that they've discussed it. Bank of England are saying that if they leave rates unchanged, inflation will go well below, significantly below the target, and our own governor said that rate cuts are coming. So clearly the central banks are going to start cutting, and it's very likely that it happens early in the spring or before summer. I do think that there is a bigger opportunity for Fed to cut rates. Rates are higher. They're probably going to implement something like 200 bips over the next 2 years, while in Europe I would say that you're probably going to see something like 100 to 150 bips in the next 2 years. And I think it's important to underline that the US economy has remained very healthy, and the numbers that we've seen coming out lately are indicating that we're not only seeing growth, but also high quality growth driven by productivity. We don't know if that's going to remain the case, but the US numbers are actually fairly benign.
That leads well into discussion about the strong report season so far in the US, especially with the tech sector, cloud, IE acceleration. Where is this taking us?
Well, I think the US reporting season has been very strong. We now have 60% of market cap reported with all the big tech. My most important takeaway is the increase of AI-related revenues in Microsoft, that we already now can see that tick up. And I do think that's going to be the theme. So now GitHub Autopilot is being rolled out. All programmers are now generating code on AI. We've seen a bit of actually layoffs in the tech sector in the US last year, and that is clearly driving productivity given how strong growth are. I think the next AI wave will be the Microsoft Office package that we all use, that will be coming online during 24. And after that, I do think that companies like ServiceNow and Salesforce are going to implement these type of AI aids into software as a service companies. And beyond that, we can talk about the legacy. But the short wave, I think, is already coming. And given that programmers are early adapters, and that it's fairly easy for all of us to get used to this in the Office program, I do think that this is going to drive revenues already 24 and clearly continue into to 25. So I think that's actually the most bullish thing in this reporting season.
And then we also had some European data numbers coming this week. Where do you see Europe?
Well, Europe is in the doldrums. We got the GDP number for Germany, where you only see 0.1% growth year on year, in very deep contrast to the US, where growth is clearly slightly below 3%. It's a bit better in the Mediterranean area, but the whole of DACH is kind of seeing very, very soft growth. We also got the consumer prices, and they came down a bit, and clearly we are seeing that they are getting closer and closer to the target. A little bit worrying that the European labor market has remained so strong. We had only 6.4% unemployment in the latest number. And if you look at on a broader scale, unemployment in DACH, Germany and the German-speaking countries have been unchanged for the last 12 months, while we've actually seen unemployment in Spain and Italy coming down a bit. So labor market is a restriction for ECB. So for ECB, it's about very soft demand and clearly also a need to cut rates because inflation is coming down. So in Europe, rate cuts are driven by soft demand, while they in the US are driven by better underlying performance, not the least in terms of wage increases and productivity.
The global economy then overall, if we have all of this in the US and in the Eurozone, how healthy is the global economy?
Well, we got the assessment from IMF this week. They've revised the forecast up a bit, but it's still 3% global growth, while Asia and China and India is growing 4 to 6.5%. So growth is driven by Asia. Interesting to note that IMF actually are mentioning AI as a potential upside factor in the risk assessment. So if IMF is saying this, they are able to back it up with some kind of research and numbers. So that's important. They are also noting that this inflation has gone faster than expected. So 80% of the economists that they do forecast for are now seeing inflation coming down. They will, in their forecast, will only have inflation 0.6% above inflation targets mid-year for 24, and almost all the economies are hitting their targets in 2025. So I think the conclusion is that, well, growth is not spectacular, but it's improving. So I think we are in a bit of a better space. When it comes to the risk assessment, I do think that it's fairly balanced. I don't believe that these geopolitical risks are kind of so elevated that you might see in the press. Oil is actually at 80. Oil is flowing. So I think that's an important kind of a lid on the risks. I don't think that the US presidential election will be a big negative factor for the stock market. We can all have different political views, and we're all allowed to have political views. But when we try to assess the stock market impact, I think it actually is going to be a strong year for the US regardless of the outcome in the presidential election.
Great, thank you. Any comment to sum it all up? There was a lot of information.
Well, I do think growth is improving. I think stocks for a long run is a good buy. And I do think that the risks are more balanced than they used to be.
Perfect, thank you.